Hello everyone, you're very welcome to this pre-scene analysis of CIMA's February 2020 operational case study, which is dealing with the fictional business of Lottie Graphite, a pencil manufacturer. So over the course of the next 3 or so hours, I'll be analysing this pre-scene document top to bottom, highlighting the most important issues as they arise, likely exam issues that could come up on the day of your exam, relating all of this information to key theories from your E1, F1 and P1 studies under the 2019 CIMA syllabus. So we'll be talking in depth about theories relating to the new syllabus from CIMA as they relate to this pre-scene. This is the 37th time, I believe, if I'm counting correctly, that I have done a pre-scene analysis for CIMA. So along the way, I've learned a thing or 10 about what constitutes the most likely exam issues and highlighting the different theories, as I said, as they relate to the pre-scene document. So without further ado, let's take a look at the opening section of the pre-scene. So turning to page 2, we're presented with your role. You, we're told here, are a finance officer working within the finance department of Lottie Graphite. Now, interestingly, it's noted that your role changes regularly. So that is interesting because it's not really something that has come up in previous pre-scenes. So under the 2015 syllabus, it was a lot clearer. You were a finance officer and you dealt primarily with financial accounting and management accounting issues, and you would occasionally interact with other departments. But here it's being stated that your role, it changes frequently, and that will be referred to later on in the pre-scene. So basically what CIMA is telling you here is, as a student, you can expect anything on the day of the exam. In particular, it's important to review E1 theories, and E1 is the subject that has changed most between 2015 and 2019, the new syllabus. So we'll be talking a lot about E1 theories as we work through this document because they're particularly important in relation to the new syllabus topics. Management accounting topics P1 and financial accounting topics F1 have changed little between 2015 and the new 2019 syllabus. So they are more or less as is. So the two more conventional parts of your role as a finance officer would relate to management accounting, preparation of budgets, both weekly and monthly management accounts, providing cost information to management teams, and also assisting with the preparation of financial statements and answering queries as they relate to financial reporting. Furthermore, and this is the part that would be more related to E1 and would involve you moving between different areas of the business. You'll be analysing purchases, sales and payroll and be involved with decision making. Now, decision making is covered in depth in P1. There is an area of the P1 syllabus, as there was in the old syllabus, relating to short-term decision making. So it might be the case, for example, that you are presented by your manager with an opportunity that the company has to opt to produce for a third party, and there might be an accept or reject decision to make, and you would be asked to consider their relevant costs. So in other words, you would have to focus on costs that would come up in the future due to the new contract, would be incremental in nature and would be cash flows. So you wouldn't be taking account of something like depreciation for the consideration of an accept or reject decision there. So that is one example of short-term decision making. Relevant costs from P1 is likely to be important, so that's well worth reviewing. And I think as well, given what's said later on in this pre-scene, that this is a company with many with a big reliance on its IT systems, and it's got a lot of data coming into the company that's being analysed by finance teams. And what's going to be very important is that finance teams and you as a finance officer know how to make sense of the huge amounts of data coming into the business on a daily basis. And that is very related to a new syllabus area from E1 relating to data and information in a digital world. So that would relate to, for example, big data and making sense of that big data, the volume and variety of that data coming into the business on a daily basis. How do you as a finance officer make sense of that? How do you make sense of that for your superiors so that they can make decisions that make sense for the business? So it's going to be fixated on data analytics, for example, and data visualization. As the old saying goes, a picture is worth 1,000 words. So if you can make recommendations as to how data could be presented in a more visual and easily digestible format, that would be very valuable. Another area that's going to be important, I think, is process automation. Increasingly in the finance area, as well as other areas of the business, but you as a finance officer will be dealing principally with your finance area. Routine transactions and the processing of transactions is increasingly being automated, done by software. So what does a human offer? Well, a finance officer is increasingly meant to make sense of the data, to interpret it, to look for patterns between data sets, and to use his or her judgment when making recommendations. So those creative parts of the finance roles are going to be increasingly important with the onset of automation of what was previously done by human beings. So all of that is going to be important to consider in relation to data and information in a digital world. So, thinking a bit more about this first paragraph, you as a finance officer are going to have a short-term focus. So your time horizon is likely to be less than a year. You'll be dealing with issues that relate to the business on a day-to-day basis, the operational side of the business. So you'll be talking about the execution of tasks rather than the grand strategy of the business, which is more something done by directors and the CEO and the CFO and the senior management teams. Costing, budgets, variance analysis is going to be very important, all related to P1. So given the fact that you take care of monthly and weekly management accounts, you can be sure that on the day of the exam, it's very likely that you could be presented with sales figures, for example, comparing budget figures to actual figures, and you'll be asked to make sense of the variances between both. Working capital management and cash management as they relate to F1 will be important, and we'll talk more about that when we look at the receivable days, the inventory days, and the payables days in the financial statement section. And assessing risk in the short term will be important too. Exam questions, they may test your understanding of a number of finance roles, as we've seen, such as planning, forecasting, resource allocation, performance management, and financial reporting. So the operational case study is very much fixated on technical skills. 64% of the overall marks relate to technical skills. So make sure that you know your technical areas of F1 and P1 well, the ones I was just talking about: costing, budgets, variance analysis, and working capital management, cash management, etc. Revise those areas and ensure you understand them. Many students worry about the need to do complex calculations on the day of the exam. That won't be the case. For the case study, it's more about interpreting tables of figures. So it's quite common that you would be presented in an email with some set of figures, maybe comparing the company to its rival across different financial ratios maybe, or different financial performance figures. Or you might be asked to take a look at budget figures and comparing one period against another period, for example, and looking at the actuals as well. So you'd be expected to spot any erroneous assumptions on the part of the person sending you the data. It could be a non-finance person who you need to correct their errors, and you'll be expected to make sense of the figures. So as a finance officer, with a fixation on the operational day-to-day execution of tasks, you're really expected to assist the decision makers in the company. You're not the one making the strategic decisions, and that will be left to the senior management, but you will be expected to make sense of data for them and to make sensible recommendations. Remember, any advice you give needs to be ethical. Watch out for potential breaches of the CIMA Code of Ethics, those 5 principles of objectivity, professional competence, confidentiality, professional behaviour and integrity. It could be, and especially given the fact that this is actually a family-run business where family members are still heavily involved, could be that one of these people that have a lot of influence come to you and they want to present figures in an overly optimistic light, and you would be expected to push back and make ethical recommendations. So we've considered your role as a finance officer. Now let's have a look at Lottie Graphite, your employer. Lottie Graphite, we're told, is a manufacturer of graphite and coloured pencils. The company is based in Gauland, which is a fictional country, based in the non-fictional Western European region. The currency is fictional, the G dollar, so we don't really know what country this could be in real life, nor is that particularly useful to speculate on, but Gauland, as a Western European country, we could consider it to be probably quite a developed economy. There are pros and cons that come with being a developed economy from Lottie Graphite's point of view. On the one hand, there's likely to be good infrastructure, roads, etc. And we look at the importance of their logistics system in transporting their goods around the country. So that is a plus. They're likely to have access to a well-educated workforce. And indeed, in their home market, customers are likely to have a good degree of purchasing power. So all of that is favourable for Lottie Graphite. There are downsides, though, to being based in a wealthy country. And they would include the following: higher factor costs. So it will be more expensive in general to operate in such a country compared to developing countries. And that will come up a little bit later on. We'll discuss that possibility soon. But in Gauland, it's likely that salary expenses are going to be higher for the company. Also, the company is going to have to deal, most likely, with more onerous regulations than in a less developed market. We're also told in the next section that the company is long running. 1902 it was established, and it remains in the ownership of the founder's family. It's still privately owned. And in fact, the top person at the company is a great-granddaughter of the sister of the founder. Right away, we would ask whether there is a danger of nepotism here, that the managing director has received her role just because she's a family member. That is a danger with family companies. So just as we discussed the pros and cons of being based in a developed economy, we should discuss the pros and cons of Lottie Graphite being a family business. With family businesses, they tend to take a longer term view, particularly when they're privately owned. They're not listed on the stock exchange, so they're not subject to pressures from outside shareholders. So the owners of the company, still that same family, so they're not likely to be as shaken by an unprofitable quarter, for example, as shareholders looking for a quick return. So they take that long-term view, and they have owned this company over generations and presumably would want it to go on for future generations. So in that sense, there's more of a sense of solidarity, that they're all pulling in the same direction, and as well, there tends not to be as big a problem with the agency issue. So the agency problem is where there is a disconnect between the people running the company and the people who own the company. So it could be in a company that you have your shareholders and then you have the executives running the business on a day-to-day basis. And because the shareholders don't have intimate knowledge of what's going on day-to-day, the executive team decides that they're going to act in their own interests and chase short-term profits, for example, or short-term hike in the share price if their remuneration is linked to share price performance at a cost in the long term, that there are all sorts of problems built in that they're not taking care of that will play out in the long term, but they'll be well gone by then and the shareholders will have to deal with that problem. But with a family-run business, they're the owners of the business, but they're also the ones, it seems, running the business. So their interests are very much aligned. Now, the cons of being a family-run business would relate to feuds. When family members fight, especially when there's money involved, the arguments can be particularly vicious. So that is a problem. There could be jealousy amongst family members if one is overlooked and one is promoted, for example. Especially when companies have been around a long time and they've always kind of done things in the same way. There's a danger of conservatism and a resistance to change, although I don't think that is the case with Lottie. We'll discuss that in a while. And nepotism, as we discussed, is a potential problem for family-run businesses. As a privately owned firm, Lottie is likely to be subject to less public pressure. They're not going to have shareholders, pressuring them on a quarterly basis to turn out those profits. They can have an unprofitable quarter every now and again, and they're not going to lose their nerve. They're not subject, obviously, to the same onerous regulations and inspections and expectations to publish quarterly audited accounts that a publicly listed company would have. However, they have limited financing options. They cannot tap shareholders for equity funding. They would be relying mostly on debt. So let's move on. Although little has changed in the wooden pencil technology for the last 300 years, the technologies used to produce the pencils has. And we see here that Lottie has not waited around. In fact, it's always embraced change. So it is not falling into the trap, as so many family-run businesses do, of being excessively conservative. They've taken the lead with technology. They've automated processes to improve production efficiencies and ensure the product is of high quality. So they've innovated. Although they've innovated not so much in a transformational, revolutionary way. Instead, they've just done it step by step, little by little, in an incremental way. So, as this relates to P1, risk attitudes and appetites, certainly the company is proactive when it comes to change, but they're not taking huge risks. They are taking a step-by-step approach, which is quite prudent, it seems. And it's worked, because we'll see later on their financial statements are in pretty good shape. They have a solid gross profit margin of 45%. So that attests, I think, certainly to the advantages of automating processes would get their cost of sales figure down and bolster that gross profit margin. So we're told about the way they've innovated over the years. For example, they were the first company to use hexagonal shapes rather than round shapes. And they were the first company, it seems, to use water-based paints, which are more environmentally friendly and also better for children to use, because children are always putting pencils into their mouths, and certain paints can be a little bit toxic. So obviously that's a big plus and shows they're watching out for the end consumer. And 5 years ago, it seems the latest innovation was a Pexico Eco Pencil, which we will look at later on, but it's produced using bits of timber that are usually cast off and not used, so it recycles those to use for the production of the Pexico pen. So it's environmentally beneficial, and we're seeing that this company takes its corporate social responsibility obligations quite seriously and is looking out for the environment. And they're taking this technology or this production method further because they want to adapt this environmentally Pexago pencil to turn it into a stylus for laptops and tablets. So it's a pen that could be used to scribble on laptops and tablets. So that's an example of the company, again, innovating, changing with the times. And in relation to Ansoff's matrix, that shows that they're interested in new products and new markets. And that is a diversification strategy, which, again, as I said, shows their willingness to embrace change. That, however, move towards technology might involve overhauling their production processes and their way of doing things. Think about your E1 studies and business process re-engineering. It might be necessary for the company to examine their production processes and change some of them to adapt to the production of the stylus for laptops and tablets. All products, we're told, are manufactured on a site close to the location where the company first began. Although Goland is a high-wage economy, which we mentioned before, the directors have consistently, it seems, resisted pressure to relocate to other countries to get their production costs down. They believe it's important to the culture of the company to maintain their presence in Goland. They feel that they're committed to the workforce there. And that, again, shows that they seem to be a responsible company. And as a family-run business, they feel an obligation to the community in which they are based. And it is worth asking the question now as to whether they might come under pressure from various parties to consider a move to a lower wage economy if their financial results took a hit. Now, at the moment, they don't have external shareholders pressuring in that way. If they were to list on the stock exchange, it's arguable as to whether they would continue in Goland and whether they could resist the pressure to relocate to a cheaper country. So keep this in mind, though, when you're making recommendations on, the potential for outsourcing or relocating to other lower cost countries. It's important for the culture of the company. The directors are resisting. They want to stay in Goland. So it seems to be a big part of who they are. Lottie Graphite, we're told, runs public factory tours once a week, which is good PR. Now, labour, interestingly, when we look at the budget figures later on, it's only a very small part, direct labour, of overall costs. So that's another reason perhaps not to relocate to other countries, because you wouldn't actually save much in direct labour if you were to relocate. So next we're told that the company manufactures just under 300 million pencils a year and sells throughout most of the world through its extensive distribution network. So in having this extensive distribution network, we'll see later they have warehouses and transport presences and sales presences in different countries. They exert more control over their supply chain. That allows them to coordinate their supply chain because they're in control of it. They are able to consolidate perhaps management teams and lower unit costs and achieve economies of scale as a more integrated company. On the con side, though, of being more integrated and having more control over the entire supply chain, it's likely that they have to spend more to do that, and they are likely to be perhaps less focused on their core area of producing pencils as they get distracted with the other parts of the supply chain. They are a premium quality company, and it's worth asking whether that allows them at this stage to charge premium prices. But in the mind of the consumer, they are a premium company, and that is useful from a market positioning point of view. It allows them probably to charge higher prices. They have just over 1,000 employees. For a company that has been around for so long and has a global presence, that's a relatively low number of employees. It seems that automation and the use of robotics has reduced the need to have employees, which saves on overall costs. They distribute throughout mainland Europe North America, South America, and Australasia. So very, very globally, geographically diversified. They have very good reach, and they have employees supervising procurement, inventory management, distribution and sales in those different markets. So they are close to their markets. They have people dispersed throughout the world, and their financial results have been pretty good, it seems. 151 million in revenues in 2019 and 12.3 million in profit before tax. So that means they had an operating profit margin of 8.7%, which is up from 8.4% in 2018. It's worth asking what the industry average is at this stage. We are not told that in this pre-scene, but overall that's a pretty solid operating profit margin. It seems the business also has a strong brand, which I think is very, very important in this industry. These are commodity-like products. No one really gets excited about pencils. And when I say a commodity type of product, it's one which the market treats with mostly indifference. No one really gets excited about oil or sugar or these commodity-like products, products that are mass-produced and largely unspecialized goods. You think of something like computer memory. Again, it's not something people get very excited about. You wouldn't really know who's making the chips that go into your computer often, and you wouldn't really care as long as it works well. So in the face of that, you're going to have a strong brand to differentiate yourself. You're not really going to be selling on the product itself. Rather, you're going to be trying to develop a strong brand around your offering, one that generates trust, one that generates name recognition. So marketing is going to be very, very important.